September is a notorious month for Bitcoin, marked by volatility and unpredictability. Historically, it's a make-or-break period, testing the digital asset's resilience. Traders analyze past data, searching for patterns, as bullish optimism often turns bearish. This month sets the tone for the year's final quarter, influencing market sentiment. As September 2025 begins, the question is whether Bitcoin will follow historical trends or forge a new path. Understanding the September effect is crucial for making informed decisions in the crypto market. The interplay of human psychology and global events shapes this pivotal month in digital finance. September has earned a notorious reputation among Bitcoin investors, often regarded as the most challenging month for the world's leading cryptocurrency. Year after year, traders and analysts brace themselves as the calendar flips to September, anticipating volatility and downward pressure on prices. This recurring trend has become a focal point of discussion in the crypto community, with many wondering why Bitcoin seems to struggle during this particular month. Historically, September delivers an average negative return of -3.77% for Bitcoin. This figure stands out, especially when compared to other months, and has led to a sense of caution among both seasoned and new investors. The persistent red numbers on charts and tickers reinforce the idea that September is a time to be wary. In fact, in 8 of the last 12 years, Bitcoin has ended September in the red. This consistent pattern has prompted many investors to adopt defensive strategies, such as reducing exposure or hedging their positions in anticipation of potential losses. The data is hard to ignore, and it shapes the way people approach the market as summer ends. More than half the time these losses are in the single-digit range, which might seem minor at first glance. However, even small, consistent losses can erode confidence and impact trading decisions, especially for those who are new to the market or have significant holdings. On the flip side, gains during September are noticeably less frequent. The few green candles that do appear on the charts are often overshadowed by the prevailing trend of losses, making profitable Septembers feel like rare exceptions rather than the rule. This well-known pattern has, over time, become something of a self-fulfilling prophecy. As September approaches, traders often preemptively sell their holdings, hoping to avoid losses. This collective behavior adds even more downward pressure to the market, reinforcing the cycle and making it harder for Bitcoin to break free from the September slump. The September slump has become part of crypto folklore, a story passed down among traders and investors. It's driven not just by data, but by sentiment, collective beliefs, and the psychological impact of seeing the same pattern repeat year after year. Understanding this historical context is crucial for investors. It allows them to prepare both mentally and strategically, knowing that a dip in September is not necessarily a sign of deeper trouble, but rather a recurring feature of the market's rhythm. Instead of panicking when prices drop, investors can view these movements as part of a well-established historical pattern. This perspective helps reduce emotional reactions and encourages a more measured approach to market fluctuations. By recognizing the difference between typical September dips and more significant market shifts, investors can make better decisions. This knowledge acts as a filter, helping to separate normal seasonal volatility from genuine warning signs. The so-called September effect is a powerful reminder that markets are shaped not just by numbers, but by psychology and the collective actions of participants. Understanding this can be just as important as analyzing charts or reading news. For those new to the world of crypto, this historical context is invaluable. It provides a sense of perspective and helps newcomers navigate the often turbulent waters of the Bitcoin market with greater confidence. Ultimately, understanding the September slump gives investors a framework for interpreting market movements, making informed decisions, and staying resilient in the face of volatility. Bitcoin's August performance often sets the stage for September's volatility. A strong August can cushion against September's pressures, while a weak one amplifies them. In 2024, a red August set a nervous tone for September. Analysts watch August's end for trend signals, as it impacts September's market dynamics. In 2025, Bitcoin's surge to new highs presents a test. Can it defy the September slump? The transition from August to September is crucial for market sentiment. A strong August could mean a less pronounced September effect, or a dramatic correction if profit-taking occurs. The echo of August's performance is the opening chapter of September's story. This dynamic creates heightened trader anxiety and strategic adjustments. As September 2025 begins, analysts are divided on Bitcoin's price direction. Bulls point to recent highs and ETF-driven capital influx, predicting further gains. Bears warn of historical trends, suggesting a correction is likely and healthy. Some predict a drop to $100,000, while extreme scenarios suggest $55,000. Strategists see opportunity in volatility, advocating for nimble trading strategies. Dr. Profit suggests playing both sides, shorting highs and buying corrections. The wide range of predictions highlights the market's uncertainty. The bullish case relies on recent performance and new dynamics. The bearish case is rooted in historical data and market cycles. For investors, understanding both sides helps prepare a balanced strategy. Bitcoin's price is increasingly tied to the global economy. As the world becomes more interconnected, the flow of information, capital, and policy decisions across borders has a direct impact on how Bitcoin is valued and traded. Investors now watch not just crypto news, but also global financial headlines, knowing that a single event in one country can ripple through the entire market. U.S. Federal Reserve policies, especially interest rates, are key factors. When the Fed signals a change, it can shift the mood of investors worldwide. Even a hint of a rate hike or cut can send shockwaves through both traditional and crypto markets, as traders adjust their strategies in anticipation of changing economic conditions. Rate cuts can encourage investment in riskier assets like Bitcoin. Lower interest rates mean cheaper borrowing and less attractive returns on traditional savings, pushing investors to seek higher yields in assets like cryptocurrencies. This often leads to surges in Bitcoin demand as people look for new opportunities in a low-rate environment. However, surprise cuts may signal economic worries, spooking investors. If central banks act unexpectedly, it can be a sign that deeper problems are brewing in the economy. This uncertainty can cause panic selling not just in stocks but also in Bitcoin, as investors rush to reduce risk. In September 2024, a rate cut fueled a rally, but future cuts were uncertain. The market responded with excitement, driving Bitcoin prices higher, but the lack of clarity about what would come next kept traders on edge, highlighting how sensitive Bitcoin is to central bank decisions. Political and economic events like U.S. elections create market uncertainty. Elections can bring new policies, regulations, or shifts in economic priorities, all of which can affect investor confidence and market direction. Bitcoin often reacts quickly to these developments, reflecting the broader mood of global markets. Global stimulus measures, such as China's, inject liquidity into crypto. When governments or central banks introduce stimulus packages, they increase the amount of money in circulation, some of which finds its way into digital assets like Bitcoin, boosting prices and trading activity. Understanding Bitcoin's price movements requires attention to macroeconomic factors. Everything from GDP growth to trade balances and consumer confidence can influence how investors perceive risk and opportunity in the crypto market. Inflation reports, employment data, and central bank speeches influence the market. These indicators help investors gauge the health of the economy and predict future policy moves, which in turn shape Bitcoin's price trends. As Bitcoin integrates into traditional finance, its sensitivity to external forces grows. The more it becomes part of the mainstream financial system, the more it reacts to the same pressures and events that move stocks, bonds, and currencies. A basic understanding of macroeconomics is essential for serious crypto investors. By staying informed about global trends and economic signals, investors can better navigate the ups and downs of the Bitcoin market and make smarter decisions in an ever-changing financial landscape. In Bitcoin's market, whales, large holders, wield significant influence. A small number of whales control a vast majority of Bitcoin, impacting prices. Their buying can support prices while selling can cause rapid declines. Traders use on-chain analysis to track whale movements, crucial during volatile months. Whales can reinforce or defy trends like the September slump. Their actions highlight the market's uneven playing field and potential for sudden swings. Recognizing whales' power helps contextualize volatility and encourages caution. September 2024 defied all expectations, rewriting the narrative for Bitcoin and the broader crypto market. Historically, September has been a notoriously weak month for Bitcoin, with traders bracing for losses and volatility. But this time, the script flipped dramatically as Bitcoin rallied instead of slumping, catching even seasoned investors off guard. With a remarkable 7% gain, Bitcoin posted its best September performance since 2013. This surge left bearish traders scrambling to adjust their positions as the market momentum shifted unexpectedly. The rally not only surprised skeptics but also reignited optimism among long-term holders and newcomers alike. The driving force behind this rally was a combination of powerful macroeconomic tailwinds. A pivotal U.S. Federal Reserve rate cut injected fresh optimism into financial markets, lowering borrowing costs and encouraging risk-taking across asset classes. Meanwhile, China's aggressive stimulus measures further boosted global liquidity, creating a favorable environment for risk assets like Bitcoin. As capital flowed more freely, investors sought out opportunities beyond traditional markets, fueling the crypto surge. This break from tradition was a powerful reminder that macroeconomic forces can override even the most established historical patterns. The market's reaction underscored how quickly sentiment can shift when global conditions align. The positive momentum wasn't limited to Bitcoin. Other crypto sectors experienced a lift as well, though not all tokens benefited equally. Ethereum, for example, lagged behind, highlighting the nuanced dynamics within the digital asset space. September 2024's anomaly serves as a valuable lesson. Markets are constantly evolving, and the factors that drive them can change in unexpected ways. Analysts and traders must remain vigilant, adapting to new realities as they emerge. While historical data often suggests a negative bias for September, this year proved that trends are not set in stone. Shifting economic policies, global events, and investor behavior can all conspire to break long-standing patterns. The growing influence of institutional investors and the increasing integration of global markets may be making the crypto space less susceptible to old seasonal trends. As more sophisticated players enter the arena, the rules of the game continue to evolve. As September 2025 approaches, the performance of 2024 lingers in the minds of traders and analysts, adding a new layer of uncertainty and excitement to the market's outlook. Will history repeat, or will new forces shape the next chapter? The key takeaway? In the ever-evolving world of crypto, surprises are always around the corner. Staying informed, adaptable, and open-minded is essential for anyone hoping to navigate these unpredictable waters. September's challenges give way to October's optimism, known as Uptober. October has historically been a bullish month with positive returns in 9 of 11 years. The transition from September to October is a turning point for market sentiment. A strong September often leads to further gains in October, as seen in 2024. The Uptober phenomenon aligns with Bitcoin's post-halving breakout patterns. For investors, Uptober offers hope after a downbeat September. It suggests a potential recovery and buying opportunity before the year's end. Uptober is a powerful confluence of sentiment, data, and cycles, rewarding patience. September is a month of heightened risk, where historical patterns suggest caution. The Bitcoin market is volatile and unpredictable, defying expectations. Patterns like the September slump and Uptober rally provide valuable insights. However, they are not guarantees of future performance. Key indicators include U.S. Federal Reserve actions and Bitcoin ETF capital flows. Whale movements will be scrutinized for market signals. Approach September with a sound strategy and clear head, avoiding emotional decisions. Plan for multiple outcomes, setting clear entry and exit points. September tests investors' resolve, offering opportunities amid challenges.